China and the US agree to slash tariffs. Well, after talks in Geneva over the weekend, the US and China have agreed to lower tariffs for the next 90 days. The US will lower tariffs on Chinese goods to 30% from 145%, while China will reduce duties from 125% to 10%. Geoff Yu is Senior EMEA Market Strategist at BNY. Geoff, how significant do you think this agreement actually is then?
It really is a very significant. Let's just say the outcome was much better than expected. So according to the statement, 91% of tariffs imposed since this process began have been removed by both sides. And I think that is warmly welcome to the global economy. I think markets were looking at anything below 50 or 60 would have been a good outcome. To get to where we are, that certainly is significant. And you're seeing the risk-on reaction as a result.
Well, let's talk about the markets. They've responded pretty positively in response. Does this mean stocks will get back on track now?
Well, it depends on where the track is and has the track deviated. But let's just say the track, towards further downside, that can be put to one side. And for the time being, the next phases, of course, will be one, let's see how the last few weeks of disruption, have impacted things over the medium to longer term. And secondly, where growth is going to be. That would require a lot more than tariff resolution because some structural issues are in play as well.
But should we be worried about the fact that it's just a 90-day pause?
Well, I think the view is that there's a mechanism in place now to continue dialogue. And I think one of the issues that both sides highlighted was just re-establishing communication. And that is in place. And as we saw with the UK-US deal last week, other things will need to be sorted further down the line. And we have to look out for sectoral tariffs as well. So this is going to be an ongoing process. But I think the market's just reassured that there is a mechanism in place to de-escalate. And that's important.
Now, we saw that the dollar surged on the news and the yield on the 2-year also moved higher in response to the news. Could this make it easier for the Fed to be more aggressive when it comes to rate cuts?
I think from the Fed's point of view, so the first thing is it removes one of the risks, right? And you can read this risk both in terms of an upward shock for inflation due to supply issues, but also there could be a downward shock to inflation via growth as well. Just borrowing something from the BOE, it could be a significant disinflationary shock, but also a moderate or a light inflationary shock or somewhere in between. So from the Fed's point of view, I think given where the market's pricing is, gradual easing up ahead due to a slowdown, that was taking place in general as well. But I think what they can look forward to is just less variability and just the conformity back to their central projections, rather than worry about shocks here and there, which makes policy making very, very difficult, as many have highlighted over the last few weeks.
And what about the other central banks around the world, say the likes of the ECB and the Bank of England?
Well, the Bank of England's really fascinating, given the three-way split. It really depends on your focus on wage growth, actually. And Deputy Governor Lombardelli, just made a speech today on this matter. And I think the issue with the UK right now is, what if we have this divergence where headline inflation comes down, due to energy prices and the like, but wages do not come down due to supply issues, due to structural issues, and that actually makes the BOE's job a bit harder. I think it's a bit more simple for the European Central Bank. They've committed to an easing path, and they're seeing much faster moves in inflation back towards target. So I think within a European context, that spread between where UK rates are versus where continental European rates are. Look at the Swiss, for example. Markets thinking they go back to negative later this year. So that is only going to widen. Does that help sterling, though? I think that's a different question.
Now let's turn to China. What about Beijing? Can it hold back on some of its stimulus measures?
No. And I think, that is the medium to longer term plan, needs to be highlighted at the same time. Simultaneously, when they released the joint statement with the US, China also released a white paper looking at the next 10 years. Look at the strategic imperatives all the way out to 2035, building resilience. That's something that's been highlighted for many, many years now. So to do that, I think they need to think about restructuring the economy, and that will require fiscal stimulus. We saw that vast array of monetary stimulus last week, about 10 measures, I think, to support things from consumption to elderly care, for example. But the follow-up needs to be fiscal. I don't think this changes the picture because growth needs to be sustained at close to 5%, and we think it will get to 5%. Pending fiscal stimulus. So that very much is still live.
That was Geoff Yu from BNY. And don't forget, you can watch more videos on Reuters.com.